Hello, America and the world. This is Radio Free Market, and I am your host, Michael McKay. We are behind the lines of socialism, my friends, and Radio Free Market is the voice of free people and free markets. Our topic today is money and freedom and how they are connected with Dr. Robert Murphy. Let me tell you that Dr. Bob Murphy is an adjunct scholar at the Ludwig von Mises Institute and a prolific author of many essays and books, including his newest, Lessons for the Young Economist, which is an excellent introductory text. I also highly recommend Dr. Murphy's blog, Free Advice, and frankly, I recommend reading all of his work, which will keep you pretty busy due to the sheer volume of his scholarship. Next, I want to tell you about Mr. Pat Barron, who is our guest host today and the originator and developer of this show. Pat teaches Austrian economics at the University of Iowa and has been a professor of banking at the University of University of Wisconsin's graduate program in banking for the past 20 plus years. I asked Pat and Bob to do this show to go over the most essential basic points about money and how it works. This interview will provide you with foundational knowledge about money, banking, and how they are connected to freedom. The show is something that you will want all you care about to listen to. Next, you will hear Bob Murphy and Pat Barron.
Well, Bob, this is Pat Barron, and I really appreciate you being on Radio Free Market and allowing me to interview you and ask you a bunch of questions. The topic today is going to be money and freedom, and sort of the general idea is that when money is the proper kind of money, then the citizens enjoy all manner of freedoms, but when money is the wrong kind of money, then government can thwart our freedoms, and we are less free. So that's what we're going to explore today. So the very beginning of this for our audience, I believe, Bob, would be for you to explain what is good money and what is not so good money. Would you go into that? What is money?
Well, sure. So, I mean, what money is from an economic standpoint, the technical term is a medium of exchange, and that just means that you sort of break up the buying and the selling of something, so that, you know, if I'm going to give a lecture and ultimately what I want to do is to be able to get food from the grocery store, I don't have to go and find someone who has food who wants to hear an economics lecture. That I split those transactions up. I go find other people who want to hear the lecture, give it to them, they give me money, and then I go to the store and use that money to buy the food. So that it really, the use of money broadens the ability of people to find mutually beneficial trades with each other. It widens the scope of trade. So that's what money is basically doing for us. Now, in terms of good money versus bad, well, in the marketplace, money arose spontaneously through voluntary transactions in the marketplace. It wasn't invented by government. There was people, originally in barter, and they started trading with each other, and money emerged. And maybe, when we come back from the break, I can talk more about that. But it was a commodity. Good money, market-produced money was a commodity that was useful in its own right, and people just started to value it for its role in liquidity and storing value, as it were. Whereas what we have now is called fiat money, and that's just paper that's printed up by the government, and there's really nothing backing it up. And the only thing that maintains its value is the government promises they won't print too much of it in any given year. And that's really sort of a dubious foundation that our money is basically just in the whim of what the Federal Reserve officials do. And that money, they can just create trillions of dollars at will, and that really leads to the possibility of debasement.
That's very good. This first segment of ours is very short, and I see that we just have a few seconds left. So, folks, when we come back, we'll explore further the idea of good money versus bad money. Stay tuned. Okay, folks, we're back talking with Dr. Bob Murphy, and this is all about good money and bad money. So before we took our commercial break, Bob, you mentioned that good money arose out of the market. It rose as a commodity, and it's to be contrasted with fiat money, which is paper money. So how did that happen? How did it happen that we wound up with fiat money, and exactly how is fiat money produced?
Well, sure. So originally, like I say, in the marketplace, people gravitated towards real commodities, things that had intrinsic uses for other things that people would do in production, like gold and silver, for example, were used in jewelry, and they had certain industrial purposes. So those things were used for other reasons, but then because of their properties, people realized that they really were a good source of a good money. That gold and silver, you can divide it up very easily. It's easy to make change with it. They're very durable. You don't have to worry about it deteriorating over time. And in terms of historical experience, their purchasing power was really convenient, that if you wanted to make a big, expensive purchase, you used gold. For smaller, everyday transactions, people just would carry around silver coins. So that's why people gravitated towards those, and that's why that was sort of like the worldwide money of the free market. And what governments did, the way they sort of weaned the public off of this market-produced money and got them to just use these intrinsically worthless pieces of paper, was originally they would link the paper to the precious metals. Right? So for a very long time in the United States, for example, if you had $20.67 in currency, that legally entitled you to an ounce of gold. So the U.S. government, the way it got people to walk around with the green pieces of paper and use them as money and to trust them, was that people knew ultimately those dollars were as good as gold. And then FDR in 1933 took the U.S. off the gold standard. He just totally reneged on those contractual promises, made everybody turn in their gold under threat of a severe prison penalty. And then we were briefly on a gold exchange standard after the war, and then Richard Nixon finally killed the gold standard altogether in 1971. And at that point, just said, actually, we changed our minds. Now, if you turn in dollars, you don't get anything, whereas you used to get gold. So it was a gradual process, but originally, no, people didn't just start walking around with pictures of U.S. presidents in their wallet. That those things were tied to the market-produced money, and then the government just through various stages said, actually, we changed our mind. We're not doing that anymore. And at that point, people were used to using that stuff as money, and so it stuck.
Well, and one of the major advantages of a commodity money like gold or silver is that there's only so much of it, so it can't be just manufactured in unlimited amounts. Is that right? And but yet fiat money, Bernanke the other day said he's going to give us another $600 billion of it. I don't think he went out and dug that up anyplace. I think he actually just kind of added a few zeros to a computer screen someplace.
Well, yeah, you're exactly right. And that's really, it's funny when you see people talking about this, and a lot of modern economists, they're focusing on real technical details, and they say, oh, no, well, see, if we have the Fed and the fiat currency, they can tweak this and they can do that, and if aggregate demand, and they're missing the big picture that, as you say, right now, Bernanke literally could destroy the dollar tomorrow if he wanted to. He could just create a quadrillion new dollars and dump it in the economy just by pressing some buttons. They don't even need to print it anymore. It's just like you say, it's computer entries. And so the very foundation of our economy, the money itself, is under just constant threat of being destroyed. And this isn't just some idle worry. I mean, that really did happen in countries. It happened in interwar Germany. It happened more recently in Zimbabwe, where they just kept printing money to pay the government's bills, and then eventually the inflation just got so bad that people abandoned the currency altogether. Whereas under the precious metals, gold or silver or other things produced by the market, like you say, the one virtue of that, or the fundamental virtue of that, is that to get more of the gold or the money into circulation, you have to go dig it up. And so there's a break there. There's a check on how much new money can enter, and so that's why people are more confident. And so when you think back to what is it that money is supposed to do, remember that first example I gave, that it allows you to break up transactions so that you can sell what it is you want to sell, get money for it, and then you can down the road make your purchases. Well, that very function or purpose of money is thwarted or at least crippled if you don't know what the purchasing power of the money is going to do in the meantime. That money that doesn't hold its value is not as good money. And so that's really, by having this ability of the Fed or the other central banks around the world to just create gobs of new money whenever things get inconvenient, that might seem like a good idea in the moment, in the crisis, but it just robs money of its very foundation in the long term, and it makes people not able to plan for the future. That right now, corporations and just regular households, it's hard for them to plan on their financial future because they don't know what the dollar is going to be worth 10 years from now.
I think we're really starting to get into the very, very heart of what this show is, trying to impart to our listeners, which is that fiat money causes all kinds of problems that do not arise in a sound money environment. And I wonder if now perhaps we could just sort of move on. I know there's the idea of money, how money is created, how it's expanded. The idea of reserves is a very technical area. Perhaps maybe another show I could do with you on that. I'd love to do that. But I wonder if we could just sort of move on to what I would just call economic disasters that are caused by fiat money. And I believe that you would agree that one of the biggest economic disasters is the boom-bust business cycle. So I wonder if you could just, as simply and as briefly as you can, tell our listeners how fiat money, the expansion of fiat money, causes the boom-bust cycle, and what actually are we experiencing. It's all very mysterious to most people.
Well, sure. So, I'm just going to give you this sort of boiled-down version of the Austrian theory of the business cycle, named for the Austrian School of Economics that Ludwig von Mises and Friedrich Hayek and Murray Rothbard were champions of. So in this view, the business cycle that a lot of people just think, hey, that's capitalism for you. There's times of prosperity when business is booming and everything's picking up, and then all of a sudden the bottom falls out for some reason and it crashes. And people just think, oh, it's psychology, or they just think that that's the way the market works. But the Austrian economists say, no, that's because of government intervention, specifically when the central bank, which is the Federal Reserve in the United States, when it wants to lower interest rates, how does it actually do that? It creates new money, and it injects it into the credit markets. So when Alan Greenspan, for example, after the dot-com bubble crashed, he wanted to lower interest rates, right, to give a soft landing to the economy. Well, how did he do that? He didn't just talk down the markets. No, he created new money electronically and injected it in the credit markets. So now there were more funds to be lent, and that's why the price to do so went down. So that's what interest rates are. It's the price of borrowing money, if that's the way you want to think about it. So that's the way the Fed lowers interest rates, is it creates new money and dumps it into the credit markets. Well, from the Austrian point of view, that screws everything up. That those interest rates are prices, and they're signals. They really mean something. And so if the interest rate was 6%, and then the Fed chairman comes in and pushes it down to 1%, that messes everything up. Now that's the wrong price. It's giving a wrong signal. And specifically what it does is it sort of gives a green light to entrepreneurs to invest in longer-term projects than they really ought to be doing. Because, if your listeners know about how present value accounting works, some project that you're supposed to put money into up front and then it's going to yield you revenue down in the future, that's going to look more attractive on paper if you use a lower interest rate when you're calculating it. And so the lower interest rates give a false sense to business people of, yeah, go ahead and invest in longer-term projects. So if that's happening all over the economy, it temporarily gives this notion that there's prosperity. In other words, it's as if there's more savings to go around than there really are. The Fed has created this artificial appearance of there's more savings when really there aren't. And so temporarily, for a few years, things look great. But really what's happening, the Austrians say, is that businesses are consuming capital, that the structure of the economy is being eroded, and people don't realize it. And then finally, when the realization sets in, that's the recession. That's the bust period, when businesses have to scale back, they have to lay people off, they have to stop in their tracks and reevaluate. Is when they realize, oh my goodness, the last few years we've been expanding and we've been trying to produce even though there's not enough material to really bring us through this. And so that's, in a nutshell, what the Austrian theory is. It's that the central bank, when it lowers interest rates, it's not doing the economy any favors by pushing interest rates down. It's just falsifying the price, and it's not allowing the interest rate to do its job. That in a market economy, the interest rate is a signal. It communicates information showing how much savings is available, and it gives a guide to entrepreneurs about what sort of projects you should start. So when the Fed lowers interest rates, it creates this false prosperity that truly is false, And that's exactly what happened during the housing bubble years.
And one of the false signals that everyone just loves is that unemployment can be very low during one of these boom periods. So when economists say, well, we're trying to create employment for folks, it appears that they're actually doing that, does it not?
Well, oh, right. I mean, people really do get jobs during the boom period, so it's understandable why it seems that it's a healthy time, but those people are being employed in projects that they shouldn't be, right? So it's the labor is being misdirected or misallocated into lines that are unsustainable. And so that's what happens, and that's why when there's a bust period, a lot of people get laid off. It's because the individual entrepreneurs in those various lines realize, wait, we can't continue to do this. This is unprofitable, and so they lay people off. And so then you have this mass of workers that now needs to get redirected and put somewhere else in the economy. So you wouldn't have these massive mistakes being made where workers are in a certain area and then they have to get reallocated across the economy as a whole. The reason you have these periodic crises, the Austrians say, is because of the government tinkering with interest rates. You wouldn't have these massive booms and busts, if the government would just stay out of money and banking and leave it to the market.
Yeah, that's very good, Bob. You know, there's several other things that it appears the government can do when it actually has the control of what we just say, you know, we refer to as has control of the printing press. We're not really relying much on the printing press these days as much as we are computer terminals. But folks, when we come back from another short commercial break, we'll continue some of the economic disasters that result from government's control of fiat money. Stay tuned. Well, folks, we're back with Bob Murphy, and I'd like to continue this discussion before we left for our break about all the problems that fiat money can cause in an economy. And Bob gave us sort of the 25 words or less, tongue-in-cheek, 25 words or less explanation of the Austrian theory of the business cycle. But there are a lot of other things that fiat money allows government to do in which it thinks it's actually helping, but it really isn't. For example, I wonder if you could talk about stimulus spending and bailouts and quantitative easing, and would these would not be done at all in a sound money environment, or at least they would be very, very limited. And I think you and I would agree that's a good thing. And could you talk about that to our listeners and explain why that's a good thing, the government can't do this?
Well, sure. So, I mean, the easiest examples are the quantitative easing and the bailouts by the central bank that have been going on. There's actually, just recently, the Fed has released more details about all the bailouts and stuff that it did. Just something like $9 trillion in total of various loans and bailouts it did behind the scenes as this crisis unfolded.
Extraordinary, Mike.
So of course, if you're the firm that's about to go under, and then the Federal Reserve comes along and literally creates $1 billion and lends it to you, you feel like, oh, that's a good thing that you kept me afloat. But from the point of view of the economy as a whole, that's not good, or that's not helpful. The Fed is not actually creating more real resources. It's not that green pieces of paper, or let alone little electronic entries on the Fed's balance sheet, makes us richer. What makes us richer, of course, is the fact that workers are able to produce more goods and services for consumers that they want. And so the Fed just creating money out of thin air and giving it to certain favored groups, that doesn't make the economy as a whole richer. All it really does is devalue how much the dollar is worth. So it's really just transferring wealth from the people who aren't getting the bailouts into the pockets of the people who are getting them. But the thing is, it's more insidious than just that. It's not merely a zero-sum game and just kind of rearranges things, but it makes us worse off because now the incentives that sets up, that these big investment bankers who got bailed out, going forward, they're not going to be as careful with their money. That they saw, hey, it's okay, we were reckless during the housing boom years, we did all sorts of loans and things we shouldn't have, and nothing happened. We got bailed out. So we made money when it was good times, and then the Fed bailed us out during the bad times. And so that's not a good lesson for the financial markets to learn. And as you say, that would not have been possible if the people were using gold produced by the market and the government had nothing to do with it, or at the very least, if we were still on a gold standard, the Fed's hands would be relatively tied. Yeah, they could print up more money, but they would know if they overdid it and gold prices started rising, there would be a run on the dollar, and so they'd have to back off. Whereas now, of course, gold prices have gone through the roof, and that, so that wouldn't have been able to happen during a period when the U.S. was on the gold standard. But now there's really nothing to restrain Bernanke except his own prudence.
Well, I think you've really hit on something here about bailing out certain industries at the expense of others. In fact, it's, as you say, it's not just a zero sum out of pocket A and into pocket B, but it's out of pocket A, you lose a certain amount, and then pocket B gets less than was taken out of pocket A. So, and I think the General Motors example is a good one. Here's maybe you could talk about that a little bit. Here's a company that has just failed for very many reasons, which means that it was misallocating capital. It was not using its capital as well as others could, but yet it still gets to stay in business and continue to misuse that capital. Could you address that, Bob?
Well, sure. And there, I think politically, a lot of the reason to explain why these things go the way they do is just look at the interest groups involved. And so obviously major investment Wall Street bankers got bailed out because they have a lot of pull. They make a lot of campaign contributions. But when it came to GM, they, of course, had the labor unions, and so they're pretty powerful politically. But as you say, they were running the company poorly. It's not like it was a shock to people to know that they were in trouble. People had been saying for literally more than a decade that their pension fund was in trouble and that they were, that they weren't running their company properly. And the thing is, just to go back to your main point on this, even in cases like with GM or some of the bank bailouts that were coming from the Treasury, so even where they're using literal tax dollars and it's the federal government doing it, so people might say, well, that's not involving fiat money because they're just taking tax money or they're borrowing it. But the point is the government right now is able to run much bigger deficits because they know the Fed is sitting in the background willing to print up new money to buy that debt. So the recent round of quantitative easing, what is the Fed doing? It's creating $600 billion out of thin air to do what with? To buy federal U.S. government debt. And so it makes the federal government more profligate. It makes them more willing to throw money around like a drunken sailor when they know ultimately Bernanke's sitting back there with the printing press, so to speak, willing to buy up their debt, and then they kind of know that once the Fed buys it, they don't have to worry about it. That the interest payments, I don't know if your listeners don't know this, the interest payments that the federal government makes to bonds held by the Fed, most of that money just comes right back to the government. In other words, the Fed earns money on the bonds in its portfolio, and then it remits the excess earnings right back to the Treasury. So from the U.S. government's point of view, any of the debt that the Fed absorbs, that's like free money to them. And so it fuels the government and makes them run bigger deficits. And if you and I agree that those deficits are a bad thing, that they're misallocating resources, well, then that's bad that the Fed makes that bigger than it otherwise would be.
Yeah, that's a very good point, Bob. I think when we come back from our next commercial break here in a few seconds, I'd like to pick up that thread of the government being too large and what we could actually do about it. So folks, stay tuned, and we'll be back in a moment.